Kia ora ana tātou katoa, tēnā koutou katoa. For those of you here in person, welcome back. It is wonderful to see you all back, and we want to leave as much time as we can for questions. So we're here to talk about our financial stability report. If you were expecting something else, you might be in the wrong room. But here we are, and I want to introduce Christian and Chris, who are here to answer questions and have been integral in the development of this document, as well as various staff members in the room. I am very pleased to be able to say that the New Zealand's financial system is resilient to a wide range of potential economic outcomes that are possible, as always, and this is in the face of very significant economic challenges globally. The pandemic continues to pose very complex economic and financial challenges for us all. Ongoing disruptions to production and supply chains, such as those that are very evident in China at present, are wearing on business confidence and adding to costs for all businesses internationally. At the same time, international travel restrictions and a lot of related uncertainties around people movement are contributing to labour shortages and constraining production again internationally. Russia's invasion of Ukraine has heightened these challenges, including a very significant impact on humanity. Trade flows are being severely disrupted by the economic sanctions and logistical issues. And with Russia and Ukraine being significant producers of both food and energy, global commodity prices are at heightened, elevated levels. Global inflation is now above what I would say the vast bulk of central banks' target ranges are internationally, and this is why you've seen a move to tightening monetary conditions globally and a rise in long-term interest rates internationally. This combination of a global pandemic and war is a significant challenge. It's unprecedented in our lifetimes, but again, I'll restate that we are confident that the New Zealand financial system is resilient, is very strong, well poised to a wide range of potential outcomes over the foreseeable future. In New Zealand, the reopening of the borders and the easing of the COVID-19 restrictions will positively impact parts of our economy that have been severely disrupted in recent times, in particular tourism and hospitality. But there will be many businesses that are tested over coming times with the rising costs and challenges of doing business, in particular as the fiscal support, the specific COVID-19 related fiscal support comes to an end. Globally and here in New Zealand, asset prices are coming off their highs. This is in particular as investors have adjusted their outlook for longer-term interest rates. So a higher longer-term interest rate in any investment decision will mean that asset prices are lower. In New Zealand, of course, house prices, housing is our key asset, and house prices have been declining since November. But we believe they are still above measures of sustainable prices. It's very pleasing that our banks and insurers are in a strong position to support the economy and provide the financial services that we all rely on. Banks remain profitable and well capitalised, very much in line with our expectations and requirements. By raising the official cash rate recently and signalling further tightening, the committee is aiming to head off rising inflation expectations. We've talked about it in part as a stitch in time saves nine, obviously removing any near-term COVID-related support, and now we're normalising the interest rate environment. We moved as we did because we want to head off inflation expectations and avoid unnecessary volatility in output interest rates and the exchange rates when looking forward. Our loan-to-value ratio requirements for mortgage lending has also limited the accumulation of high-leveraged loans, and that has helped to significantly build economic and financial resilience in New Zealand. We continue to work collaboratively, both with the industry, banking and insurance, and with the Council of Financial Regulators on a broad range of issues, from governance, risk management, capital and liquidity. So we see that by strengthening both our supervisory capacity, the legislative framework that is being renewed, as significant investment in our own capability and capacity. We are also adding to our tool set. We're looking to build and have a framework in place for a debt-to-income restriction framework. Given the current outlook and expectations, it's a good time to get the framework in place over the next 6 to 9 months. We don't sense an urgency of it having to be put to use. Finally, in addition, we continue to work with the government on industry, government and industry on some of the significant longer-term challenges that face New Zealand. Climate change, topic du jour, housing supply, another topic that we are working collectively with. So I really do encourage you all to enjoy, to read, to write about, to understand the document. Because in there it is a very rich source of insight to New Zealand's financial resilience. Kia ora, we are open for questions.
Brian Fallow, the New Zealand Herald, I guess. In terms of global risks, do you have any concern about the possibility of a synchronised recession, given that for different reasons Europe, China and the US are all looking vulnerable?
It certainly can't be ruled out. As we've seen, it was a very synchronised global hit from the pandemic, so we're all coming out of that pandemic, simultaneously, albeit in different ways. And we're talking global commodity prices that are being impacted through the Ukraine crisis. So I note that the IMF, their recent economic forecasts were very much related to the synchronised challenge that is happening internationally.
Hi there, it's Mitchell from News Hub. Thanks for this morning. Just on housing, how realistic is it that we will see a significant drop in house prices, and what would that look like?
Do you want to chat briefly about the house prices, Christian?
Yeah, so I think the key message in the document is that we do think that house prices have fallen but remain above their sustainable level. Now, how that correction comes about can come through house prices falling or those fundamentals shifting up through time. We're not putting a number on how far away they are from sustainable. It'll be something that we continue to review through time. As a financial stability report, we need to be conscious of the risks and the risks that there are of a correction. And what we underline is the sort of resilience that we've built into the financial system, such that we can cope with different shocks that may come along.
Follow up, how concerned are you about the potential impact of something like that happening on recent buyers?
So without doubt, I mean, when you look across the full mortgage book, households are in a very strong equity position, and as we know, employment is a very high level, and those are great conditions for stable balance sheets at the household level. But without doubt, over the last 12 months, people who have entered that market, and with no shortage of warning coming from ourselves, they've entered at very elevated house price levels. And they have had to be, I suppose, stress tested when they're taking on these loans by these banks at interest rates significantly above where they were. So we know that they have obviously passed these tests, but as they roll on to these higher interest rates, without doubt there may be some belt tightening that is needed. But so the average story is feeling very good over the last 12 months. People who have entered in that heightened house buying frenzy will be challenged.
You talk about house prices. Lucy from Reuters. You talk about house prices still being above sustainable levels. Do you have a percentage that you would like either prices to fall or wages to rise before they will become a level which you can describe them as sustainable?
We're indifferent because we have to be indifferent. We don't control house prices. We try to control low and stable consumer price inflation, hence the interest rate. So I would imagine a combination of both would be an ideal situation, where house prices remain reasonably flat, or continue at the pace they are. But a wonderful story would be that the values, that the underlying economic fundamentals continue to improve to justify houses. We've been talking for a long time, by the way, about house prices being unsustainable and this incredible increase in house supply, which is now coming onto the market. So what we're seeing does not surprise us. It's just the way these markets work.
Bernard Hickey here from the Kaka. Thank you very much for the report, which is a cracking read.
Thank you.
I, in particular, noticed the measure that a 30% fall in house prices would lead to a 10% of all mortgage debt falling into negative equity. And you mentioned that a significant fall in house prices could affect consumer spending through the wealth effect. How much of a fall before you become worried or concerned about the wealth effect on the wider economy through consumer spending and on the financial system?
Yeah, thank you. The numbers are as you quote, and we do, would love readers to really understand that stock of debt, outstanding plus the more recent, that is quite a different dynamic. We don't have a specific number that you asked for, Bernard, sorry, around, at what point do we worry about A, B or C. Monetary policy is a repeat game, so we will be looking at what is happening to prices at each time. At each time we reset. Around the financial stability concerns, stress testing, Chris, you want to chat about the results of recent?
So we, in our stress test from last year, we put quite a severe scenario, which included unemployment getting up to kind of 12% and house prices falling, I think, in the order of 40%. So it's a very, very significant drop. And in that stress test, we found that the banks were resilient to that scenario. Now, capital did reduce, but it was still above the kind of minimum levels.
So this is always our challenge. When we're delivering this document, we're talking about the financial system, the financial institutions and their resilience, but without doubt there are a vast array of businesses and consumers and differences that go on.
Just a key thing to underline with the stress test that Chris outlined, to put the financial system under severe stress, we really need to see unemployment rising very, very sharply to do that, because that's all about the serviceability of those mortgages and people able to continue to service those. The current environment we're in is actually one where the labour market is very strong, unemployment is very low, so we're in a different environment than those stresses, but we need to be wary of that.
Kia ora, Jonathan. Kia ora, Jonathan Milne from Newsroom. You talk about the resilience of the banks, but what about credit unions and non-bank deposit takers? Is there any concern around them or their capitalisation?
We've worked with them continuously around ensuring that they are adequately capitalised and have adequate liquidity. I know over recent times they were quite significantly challenged on scale and profitability, but around capital liquidity, it's the story as per the banks.
Yeah, and I think I'd add there's just to flag some of the material in the document about the introduction of the Deposit Takers Act, which will bring credit unions and building societies within a consistent framework with banks, so that we can have those standards that apply across all deposit takers and apply them, relevantly.
Brent? Yeah.
Yeah, Brent Edwards, NBR. I mean, just talking about those vulnerable households, do you have a number or a sense at which level interest rates would get where they would really start to get into trouble?
Yeah, Well, we do. But I think it's important first to define trouble. Trouble can mean a combination of things. It means that the price, your expected capital gain, isn't as exciting as you hoped it might be, or were told it could be by the person you bought it off over the next 12 months. But housing prices go in cycles, as we've noticed. Negative equity doesn't mean also that you actually have to sell the house. You're still living in it. It's your availability to continue to service, etc., is the real issue. But we do the interest rate and debt sensitivity. I've stalled long enough for Chris to catch his thoughts.
Okay, so two angles on this. One is when you think about a bank lending and the risk of them not being able to pay back that lending, banks have tested at around 6% over the past 12 months, and recently that has been increasing to around 7 or just above 7. So that gives you kind of a sense of what the banks have been testing their serviceability at. In addition to that, we do some of our own analysis that looks at when would households need to pull back their spending significantly, and we found that at mortgage rates around 5%, about a quarter of the borrowers from the last 12 months would need to significantly pull back their spending.
So that's recent borrowers in the last 12 months. At around current interest rates, they are belt tightening. And then going up.
And when you get to 6%, I think it's around 1/3 of those recent borrowers. When you get to 7, it's around about half of those borrowers in the last 12 months.
Important part, the last 12 months.
Yes.
Yeah, and borrowers before COVID were having their interest rate sensitivity tested at about 7.5%. So.
On those serviceability tests, could you talk us through why you've decided for now not to bring it in formally, and also on the DTIs, what your thinking is on, given what we're seeing in the housing market at the moment, with the likelihood over the next 18 months or so that they could be brought in?
Yeah, good questions. So the first one around the timing, good policy needs proper consultation with industry, and then it also needs to be able to be implemented by the industry. So the consultation and the implementation times are a big part around the timing, where we're talking, early next year, where we have a framework in place for debt to income restrictions. It's a good time to be doing the framework work because we're under no urgency given the topics we're talking about now, which is easing declining house prices. So getting the framework in place when we're not under urgency is a much healthier position than what we've been in the past. The debt to income and debt servicing restrictions were both debated and discussed. We've preferred to go down the debt to income path because it is, I suppose, it poses less imposition to significant parts of the market. Less unintended consequences from that than a debt servicing ratio does. It certainly impacts on investors harder than it does on first home buyers, a debt to income rather than a debt servicing ratio. So, we can achieve what we want better by choosing that path.
You mentioned in the financial stability report that you've got this scheduled increase in capital ratio for the banks over the next few years. Would you expect that to restrict or reduce in any way the potential lending growth by the banks?
No, we're very comfortable that the banks have that capital increase well under control as a combination of retained earnings without unnecessarily restricting lending demands. Richard, have I? Yep. So, no, very comfortable. A lot of the noise in advance has proved to be just that, and we've been able to get on with raising these capital ratios. Now, I just do want to say it's a wonderful position to be in for Aotearoa New Zealand to know that our banks are highly resilient, both on the cash and also liquidity. They've got very good access to their own cash as well as third-party cash.
Jenny Ruth from Business Desk. When you introduced the FLP, you were expecting that to lower interest rates across the board just by its very existence. Is that not the case?
Yeah, it has done. It did do. So it worked as expected. We had lower than otherwise interest rates for that side. The important part to remember with the funding for lending program is that the cost at which we lend to banks through that program is at the official cash rate, and the official cash rate has been rising through time. So interest rates have been rising with it. With the funding for lending program, I suppose to preempt your continued questions, we initiate, when we put that in, it was to maintain confidence in the financial system amongst the institutions that they would have access to funding under extreme situations. And remember, it was extreme. By the way, it's still pretty heightened. And so we gave a two-year forward-looking, said we will keep this open for at least 2 years so that banks knew they could use that funding agreement, they could have it planned in their forward-looking use for when they are thinking about going to market or increased deposit or their sources of wholesale funding. So that 2 year was a legal contract and a promise. That runs its course in June?
Yeah, the initial allocation in June and the additional through to December.
Yeah. On the way through. So I have to say it does help me sleep a little bit better at the moment, the fact that it is still there, because one of the many unintended consequences of watching internationally could well be a return to significant volatility in funding markets.
Isn't it working against raising the OCR though?
No, because it is being lifted with the official cash rate.
It's one of the unique aspects of that scheme relative to ones overseas. Many of them provided term funding at a fixed rate. So as monetary policy is tightened, that funding has stayed at that low fixed rate that it was during COVID. Ours was unique that it was priced as a floating rate that would change as we shifted monetary policy.
Do you want to give a sense of a scalar, just because I understand what you're trying to get to, and I want to try and...
The most visible funding costs, apart from the FLP, is deposit rates, and the FLP rate...
And wholesale funding.
Well, I said the most visible. It's the one that I can look at most easily.
Oh, okay, right, yeah.
And deposit rates are significantly higher than where the OCR is, which suggests that there is still downward pressure on rates coming from the FLP.
Thank you. Do you want to chat about where we've seen wholesale, just the, I suppose, bank margins and costs and all of that stuff in there? The very first thing, just while you collect your thoughts, at the margin impact of having the funding for lending program versus not having it, is that something we want to talk about here?
It would be worth less than 25 basis points in terms of overall monetary conditions. And so we have a number of different monetary policy tools, and we assess what sort of combination that we want to use them at to get overall monetary conditions where we want them to be and to signal where we want them to be going forward. Funding conditions and funding costs have been rising as we've been removing stimulus, and so that's happened through wholesale funding rates rising in wholesale markets and deposit rates starting to rise too. They've tended to rise, that the longer term fixed rates have risen first because we've sort of signalled that it's mostly about what we're going to do in the future, and now you're starting to see some of those shorter term fixed rates rise as we start shifting up the official cash rate itself.
Thanks. Just on a different topic, climate change. You may have seen recent data on sea level rise, anticipated to be going, I guess, twice as fast here in New Zealand. What impact do you anticipate that will have financial stability?
Wonderful question, and thank you so much. Very often we've been questioned as to why is the Reserve Bank even talking about climate change. I hope that your question has answered those people. Climate change and the risk it brings to financial stability is real. We have opportunities to get ourselves in positions that we can manage, mitigate and adapt. Financial market pricing is critical to the adapting, and access to capital is critical to the mitigation and management of the implications of climate change. So we have been working very rapidly and with international experts on understanding this, and I'll just let Christian just chat about the three legs of the climate. I was going to shout out to Simon, but that would be unfair because you're standing by the door. But
yeah, I mean, there's sort of what we're doing ourselves in terms of our own setting, the way that we manage our balance sheet, and the way that we take our climate change into account in terms of the assets that we have, our regulatory settings, the way that we can influence the regulated community that we're involved in, banks, insurers. They're key to this, whether they're managing risk or providing capital to industries that are exposed to climate change. And then there's the collaboration that we're doing internationally and domestically as well. And we're just one player here, but we're keen to work with government and industry going forward.
Yeah, just a quick follow-up. Are you guys confident that as a system and as a sector, people are ready to tackle this, or is there a lot more work that needs to be done in order to meet these growing challenges?
I am extremely confident people will have to tackle this. And I'm very confident that financial markets and the financial sector will be a key part to what our future management, adaptation, mitigation looks like. So, and it is very clear that investors, financial institutions and consumers have been moving in that way for quite some time. A real challenge for the globe is, around the tragedy of the commons and the tragedy of the horizons, that any one individual or any one group cannot resolve this. We have to work collaboratively, collectively. So when we are seeing national adaptation plans like we saw come out this week, when we are seeing the global effort around allocating capital towards these issues, it gives me great confidence. But really, it's going to take extremely strong leadership to work through this. This is something that is totally non-conducive to three-year election cycles. This is an intergenerational challenge that needs leadership now.
Can I maybe just jump in there as well? We've got a project where we're working with the banks, thinking about this very issue of coastal flooding, and I guess in 6 months or 12 months' time, we'll be able to give you more information about how we're seeing their exposure to that risk.
So it's a key part of our stress testing, it's a key part of our supervision, and it's even a key part of our training for supervisors and the industry itself around how to tackle the issue. And so, and it's a real challenge because you're going to have to keep funding while you're also in transition. And I heard this morning on the radio a classic discussion, which was that housing insurance may end up being not available a lot sooner than people realise. It's because financial markets are forward-looking, and they're saying, "Well, I'm not sure I want to write a 30-year contract or even a contract with annual adjustments." So we need to work collectively on this. I remain confident because that's my human nature.
Just on that climate change situation, homes in floodplains and on coastal areas that have been labelled vulnerable to rising sea levels and climate change are still being sold, insured, banked. Those agents who are selling them are saying they haven't heard anything to say they shouldn't sell them. The agents, the insurers and the banks don't seem to be changing their behaviour. That's been reflected in, properties being unsaleable. Are you confident that the banks and the insurers are far enough ahead and starting to make those tough decisions about making those properties unbankable and unsaleable?
I'd like to think about, without doubt, there's a massive gap in knowledge and a massive gap in information to be provided to assist that knowledge to grow. Some of that gap has just been filled, for example, yesterday or the day before, with our sea level rising report. This is the beginning of people being able to understand and truly see and identify themselves in this picture. What does that lead to? Does it lead to issues where people just try and sneak out and get out before you can't? Without doubt, you're going to hear stories about that. Or does it lead to the music suddenly stops and no one can get out as well, which is suddenly whole sectors or regions are no longer insurable? Now, both of those will happen in some different ways, and so we need to accept that and say, well, how can we do it? How can we adapt in an orderly fashion? How can people choose to remain in a region but know the house will never be resaleable, or choose now to move to another region, and how can they do that? The shift up the hill type stories. How can you get the collective investment for building the sea wall? Is the sea wall worthwhile, etc.? So central, local government, ownership needs to be taken of how to manage these issues, and the industries need to be incredibly transparent and forward-looking. It's in their interest to be transparent and forward-looking because they want to be doing business not just now but repeat business for a long time in the future. So, that transparency is critical.
And just finally on that climate change issue, the adaptation plan raises the questions around who's responsible for compensation or building seawalls and that sort of thing. Essentially, in this interregnum before we make the calls about who's responsible for paying or compensating or rebuilding, there's going to be this long period of plausible deniability where people are able to essentially offload the risk, privatise the profits, socialise the losses, and there's a moral hazard problem in there. How concerned are you that the insurers and the banks will be the one left holding the baby when the music stops unless the government's come up with a plan?
Well, I think it's going to be citizens who are always left holding the baby on that way through, and so citizens are going to need the information data to make their decisions. They're going to need to be assisted through that. They're going to need options. So we have to build all of that, the information, the awareness, and the options. At the moment, the options are sparse. What do? You sell and hope you get out and go somewhere higher, or whatever the particular issue is. So, those are the structures. Now, stepping back from exactly what the institutions are doing, think about the mere fact of how relative prices have already moved so significantly globally and will continue around seeing and smelling that risk and pricing those opportunities accordingly. So there's a lot of shift already going on through relative prices, through investor and consumer behaviour, but we're still lacking options. I would say governments globally need to be really making calls on options. New Zealand, we've got a central government, local governments. We don't have state governments. Hopefully that means we can be more fleet-footed and quick, but clarity around who's owning these options. Our work on insurance has shown that we are very robust. I would say our weak link around climate change and general insurance for New Zealand is this assumption we will always have access to global reinsurance at a reasonable price. Remember, this is a global shock. The reinsurers tell us that's the case. We need that transparency so that we know who's telling us the facts.
You've largely answered this, but as the regulator of the insurance companies, is there any counterpart to what Jeff Baskand was talking about as the regulator of the banks, that there is an optimism bias on the part of both borrowers and lenders, backed perhaps by moral hazard considerations? What are you hearing from the insurers about their thinking, apart from, we're fine as long as we can get reinsurance?
An enormous amount of that, an enormous amount of we need to be working with us, supervisors as well as with government and policy, because they themselves know that this is not an issue that you insure away. Someone ends up wearing the cost. And so how do you share that cost through time, and what's the role of the insurance?
Yeah, I'd reiterate that as well. Real willingness from the insurance industry to be part of the conversation, because it's their business model to provide insurance. So they want these properties, or they want things to be insurable such that they have the business model, so that they really know that they need to work with government and local government to and us to make that happen.
Yeah, I mean, to write insurance, you want to know what the local authorities are going to be saying about the area or the region and willingness to build or move, and so there's a lot of collaborative work ahead.
Matthew Brockett from Bloomberg. You've said previously that central banks need mates in fiscal policy. I'm wondering if you feel that mateship locally at the moment, and secondly, the new fiscal rules that the government's announced, which include quite a bit of a higher debt ceiling than we've previously had, do they impact on you in any way in terms of you achieving your mandates looking ahead? Yeah,
I mean, great questions. Just answering the last one first, no, the announcements from the government, I think yesterday, doesn't make any change to our broad outlook from fiscal intentions and nearness to ceilings, etc. It's business as usual from that aspect for us. More transparency, clarity from Treasury and government around longer term opportunities. In terms of the Friends side, yes, we're working very closely and very well together. Number one and number two, the Terrace Wellington, the Treasury, and Te Pūtea Matua. How do I say that? We have a Treasury Observer in our Monetary Policy Committee, for example, so we're able to understand and make sure that we're not operating on false assumptions when we are establishing monetary policy. And when I said we need friends, I actually truly believe that over the next 12 months, 2 years, as we work through these harder economic times because of the global environment we're in, that fiscal policy has a really important role for maintaining social cohesion, labour mobility, education, skilling, all of those long-term important things, as well as welfare transfer payments. And we know that that's happening in a more targeted manner than, say, only just 12 months ago now. We are post that COVID cash and confidence, and we're now back to more fiscal policy BAU. The net fiscal impulse is actually declining now. It's actually a negative drag. It's not a net plus. It's actually a net drag on economic activity because we've come from a very high level back to a normal level.
Just finally on the banking sector, which over the last 2 years has, from my reading, net reduced lending to business and agriculture and significantly increased lending to the housing market to make it among the more housing exposed banking sectors in the world. Are you concerned at all that our banks are becoming essentially mortgage banks that could become overexposed to that part of the economy and leave, business banking behind because it's too difficult or unprofitable?
Christian's going to chat about the recent changes in exposure, but at that longer term level, our concern is that the capital markets and New Zealand's financial system still remains brutally dominated by a few institutions for specific lending types. The fact that an institution chooses to be just a mortgage lending institution, deposit taking, that's fine. That's their business model. But looking at the economy as a whole, we want to make sure that access to capital is available to all, and financial services are available to all, and it matches and meets Aotearoa's needs, some of which are quite bespoke. And that remains an ongoing challenge for this country. We are dominated by debt provision for housing, and the first question a business loan person's asked is, where's your house? So, that is a continuous challenge. Just in terms of recent data?
Yeah, in terms of the bank's exposures, yes, they have been reducing their exposure to the dairy industry, and we think that that's a good news. That's a long-term story. We've been sitting up here before saying that that sector needs to pay down debt, so that's good to see that happening. Business lending has actually picked up over the last 12 months, and again we were sitting here 2 years ago with a sort of an absence of business lending and asking why that's happening. It was because of the uncertainty at that time, whether businesses really needed working capital during that phase of the economy. Now that we're in the economic recovery, things have become clearer, businesses are getting back to usual, and that business lending has picked up, which is good to see.
So agriculture down, business lending up, consumer flat. We weren't very good at spending on our credit cards during lockdown periods. And commercial property, do you want to chat a little bit about that?
So commercial property, I guess the key story there is it is a sector where investors play an important role, and as a result of that, interest rates and the dynamics of interest rates are important. So it is one thing we'll be watching that sector. The other aspect to that is the structural trends we've seen because of COVID, where you've seen more people working from home impacting the demand for office space, and perhaps the other one is more online retailing and the impact that has on particularly the retail shops and CBDs. So there's a couple of significant things there that are impacting that sector, and we'll be watching that.
Cool. All right. Well, thank you very much, everyone, and do stay well and enjoy the document. Kia ora.